Hi, I'm Jonathan Bays, and this is our September investment market review. I've got a couple of comments to leave with you on the Australian dollar, which has traded well above 80 cents in the last couple of weeks and up to a 2-year high. Some comments on the economy. We're also very fortunate this month to have Kerry, who is the Global Market Strategist from JP Asset Management, leaving some thoughts with us on the global economy and on what's been occurring on the Korean Peninsula in recent months, which I think you'll all find quite interesting.
I think investors have been concerned a lot with geopolitical events throughout the last month. North Korea, obviously an event that jumps to mind, gained a lot of headlines, and a lot of worrying headlines for many investors. As well as that, we have what's happening in Washington and the uncertainty about the outlook for politics and the Trump administration in delivering a lot of those growth promises and platforms they have. But turning first to North Korea, it's unsettling any time we start talking about nuclear warfare in the current day and age, but by and large, unless those events are really associated with a drop in economic activity of a significant level, or in fact a spike in inflation thanks to higher commodity prices, markets tend to go back to following economic and corporate fundamentals, and almost all of the time, markets tend to go up over the following 1 or 2 years. North Korea's case is no different. Slightly more worrying given its proximity to Australia, and those smaller ripples can create bigger effects if we think about the impact on Asia as a whole. But for us, staying invested in 2017 has been the right thing to do given the economic backdrop globally, and we continue to think that that is the case.
Yeah, so the Australian dollar this month has traded to over a 2-year high. Actually got to 81 cents last week, which is quite surprising and not overly positive for the economy on a medium-term view. Part of the reason for the strength in the Australian dollar is to do with continued improvement locally. Business confidence, as I've spoken about in recent months, is at a 2 or 3 year high. But also we've had an improvement in employment, and iron ore and coal exports have been doing very well as China's economy has been strong. But probably one of the biggest reasons why the Australian dollar is as high as it is has been down to weakness in the US dollar. And a lot of that's got to do with delays in reforms that Trump has promised on tax and infrastructure and on healthcare. And so markets are starting to question just how strong the US economy might look in 2018 and 2019. So at the moment, the Aussie dollar at 81 cents looks bulletproof. But we fully expect that in the months to come that it starts to weaken off because perhaps our economy here locally isn't quite as strong as it might imply.
So we look around the world and we do see a global economy that is running at an above trend rate of growth. It really is starting to soar after many years of worries about Eurozone crisis, about the levels of deflation in Japan, about just the US economy being the only source of strength. Now we see a synchronicity across both emerging and developed worlds, and that is very much a sustainable rate of growth as those different areas of the world feed back into each other through things like trade, and can see a more sustainable outlook for the economy to continue to recover.
So just like the stronger local economic momentum has propelled the Aussie dollar through 81 cents into a 2-year high, so too have interest rate expectations locally been changed in the last month or two. And we're now looking for a 0.25% rise in domestic interest rates in the coming 12 months, if you believe interest rate market pricing. Personally, I think it's very optimistic and highly unlikely to occur. Interest rates globally are going up at a far slower rate than I think many anticipate, and I don't see any reason why Australia would be any different. The local employment market is improving, and the trade side has been strong for several months. But as I've mentioned before, domestic households are carrying way too much debt, and consumer confidence is still at a 2-year low. So I think it's highly unlikely that the Reserve Bank raise interest rates anytime soon.
So in summary, I think the last month really has been dictated by a lot of noise about geopolitics, a lot of worries that really aren't fundamentally news for many investors. The impact on the short term can seem very painful, and we see increases in volatility across markets. But if we focus on the fundamentals and the recovery in the global economy, the recovery in corporate earnings, that ultimately leads us to stay invested and lean towards those riskier assets and fixed income, as well as equities around the world. I think there is a case for many investors to see past all that noise and really do focus on what is newsworthy.
So thanks for listening in. Next month we're hopeful of having some comments from one of the representatives of PIMCO, who is the largest global bond manager in the world, and so we think you'll find that interesting. Certainly if you've got any questions relating to anything I've had to say today or Kerry has had to say, please contact your advisor.